We established Metrics in June of 2013 when we launched our first fund. Myself and my colleagues have all had between 30 to 40 years of direct lending experience, predominantly working inside domestic major banks in Australia. So we established Metrics really as a result of looking to provide investors with an opportunity to participate in what is very much a private market. Most transactions where corporates go and raise funding for their operations, they're looking to the banks to raise funding. They're going and raising debt capital through the banks. So we launched, as I said, our first fund in June of 2013. It was myself, Justin and Graham that set up Metrics back in 2013. The three of us, and we started the business with one single investor, and we had 75 million invested. Since then, the business has now grown to having 11 different funds. We have two ASX listed funds. The capital under management now exceeds 4.6 billion, and the team's grown to close on 40 people. We have a presence in Sydney and in Melbourne, designed to originate transactions directly with corporate borrowers. So our skill set is very much around the ability to originate transactions using relationships, networks that we have with banks, corporate advisors and borrowers directly, seeking to find opportunities for our investors to really gain access to what is very much a private market. Across this chart here, it shows the risk spectrum from lower risk to higher risk. Our view is that loans or credit is not a homogenous asset class. When we sit down to negotiate terms and conditions with a borrower, we know that we can structure a transaction depending on the risk profile of an individual company or the risk profile that we're prepared to accept. Sometimes the companies need to put in more equity. Sometimes they need to lower their level of leverage to get to a point where you've got a sustainable capital structure. And so what we've sought to do here is really just create different funds and different vehicles that allow our investors choice. Our investors can choose what is their return objective, what is their risk objective, and importantly, what liquidity do they require in their investment. So if you think about our market, most of the loans and the companies that we lend to, they're not actively traded. They're not exchange traded. They're not available to investors to buy through the ASX. These are loans that you do deep fundamental bottom-up credit analysis to determine whether or not you're prepared to lend to the company on appropriate terms and conditions. It's our role as a lender to structure the appropriate terms, the conditions, set the covenants, monitor the risk, take security, and control the risk associated with lending to these companies. And so from our perspective, given that it is a private market, we think ASX listed funds are the most appropriate way for a broader investor market to gain access to what is a less liquid asset class. You think about it in the context of us funding a large-scale property development transaction. You could hardly say to the developer halfway through the construction, sorry, we're no longer going to provide funding to you, or we're going to sell your debt to XYZ lender. You know, they want certainty of funding. And from our perspective, we look to provide funding on terms generally between 3 to 5 years. We're active across probably 4 key markets: loans to corporates, loans for project and infrastructure purposes. We're active as a property lender, and we finance acquisition finance predominantly for private equity firms. So companies that we lend to in the ASX listed sphere, investment grade names like Caltex, Origin, Woolworths, we provide funding to those. We would be the only non-bank corporate lender that is providing funding to those companies. We're also active in project and infrastructure funding, so the Eastern Distributor Motorway or the Sydney Desalination Plant, the Victorian Desalination Plant. We finance the Victorian Cancer Centre, the Peter MacCallum Cancer Centre. We're in property, we're active in development funding and also to REITs. So we do land subdivisions, residential high-rise, we do commercial, industrial, hotels, hospitals. We also provide financing for acquisition purposes. But each of those loans that we provide across those categories allows us to determine when we're sitting with a borrower, not all credit is the same. So we have the ability as a provider of capital to set terms and conditions and to negotiate an outcome. So for instance, with MXT, the first fund that we launched in October of 2017 on the exchange was the first ASX listed fund that gave investors access to the private market, private debt loans. That fund is really designed to provide investors with an alternative traditional fixed income asset allocations. So if you think about investors' choice up until MXT, they had the option of maybe going into hybrids, maybe had the option of going into term deposits, or looking at maybe trying to construct a portfolio of corporate bonds. If I think about the Australian corporate bond market, it sits at around about $40 billion in outstandings. If you strip out financials and you strip out government and semi-government bond issuance. At $4.6 billion, we're greater than 10% of that market. So you can see it's a material market, but we're small in the context of what the banks provide. On the bank balance sheets, it's around about 1.2 trillion of assets that sit on bank balance sheets. We set up our business with the view that the banks would continue to face into increasing regulatory pressure, and on the other hand, Australia doesn't have a deep, liquid, functioning corporate bond market. So Australia has an immature capital market, and the banks are struggling to finance their operations as a result of increasing regulatory pressure. It is our view that the banks are no longer the natural holders. So what we wanted was to create a fund and a structure that allowed investors to gain access to that market, but equally to provide long-term funding arrangements for Australian corporates. So MXT launched in October of 17. We've now completed 3 separate capital raisings. That fund now sits at around about 1.3 billion in outstandings. It's very much our view that that fund should be a low-cost, highly liquid, tradable instrument on the exchange, giving people an alternative. MOT is really designed for investors that are looking to lower equity market risk. So investors that are looking to generate an equity-like return, but lower the market volatility they are exposed to by moving to the lower part of the risk spectrum in terms of being exposed to debt, secured debt or loans, as opposed to sitting at the higher risk end of the capital structure where we're exposed purely to equity market risk. And so those 2 funds are really designed, MXT, designed to provide investors with a return target of the RBA cash rate plus 3.25 net to the investor with income paid monthly. Since October of 17, we've exceeded that minimum target return. The cost structure's reduced, the liquidity in the fund has increased, and we're getting to a point there where we would like to see the trading position between a very tight range in terms of the bid-ask spread to the NAV. We've never had an issue where that fund is traded below the NAV, nor should we. If you think about lending $1 to a company, we should be receiving interest and fees. The capital should be low volatility and stable, providing a return to investors. And so if it was to trade at a discount, the market would have to have formed the view that there were undisclosed potential credit impairments in our portfolio. So we have a range of tests that we go through. We have an independent RE, and we have a process with one of the international accounting firms that reviews our entire portfolio on a monthly basis to check the validity of the prices in terms of the way in which we hold the assets, and they also test for impairment. MOT is really designed for investors, as I said, looking to lower equity market risk. And so MOT seeks to provide investors with a minimum return of 7% per annum, cash coupon, with monthly income. But as a result of our position in the market, where we're able to see companies that look to borrow money, often we see companies that have growth potential or access to capital is limited. So we seek to provide our investors with the rights to participate in upside gains. We do that through negotiation of warrants, options, or outright equity interests. So when we lend to a company, we say fundamentally, are we comfortable with the credit risk we're exposed to in terms of lending to this company? If we're comfortable lending to the company and we can negotiate the right for our investors to participate in upside gains, it's our view that our investors' capital is scarce and our investors should be rewarded for that risk. And so the total target return on MOT seeks to deliver 7% minimum cash coupon paid quarterly with upside gains of 8 to 10% over time. And that's the risk spectrum. So if I think about Australia, Australia tends to have, in terms of the loan market, a credit risk that sort of sits between A to BB credit risk. Investors often have exposure to US high yield or US term loan Bs or institutional high yield loans. Those loans tend to be BB to CCC in terms of credit risk. That market doesn't really exist in Australia. And so for us, able to then negotiate transactions with borrowers where you're fundamentally providing, say, mezzanine debt or subordinated debt, but then negotiating profit shares or you're taking warrants or options to provide upside participation rights is a recognition of the immature nature of Australia's capital market. So we think the market's very scalable, it's large, it's private, provides investors with low volatility exposure, and that's really what we've seen So if I think about MXT and MOT, we've consistently delivered in terms of the income and return targets for our investors, and consistently been able to deliver that in a low volatility environment. As I said, the firm is grounded in direct origination, strong relationships. These are market relationships that have been established over 30 to 40 years. Our team has extensive relationships with banks, with corporate borrowers, advisors and the like, seeking to originate transactions. So when we participate alongside banks, or we bring banks into transactions that we've originated, it's designed to ensure that the company has access to funding. But equally, we're very much about building long-term sustainable relationships with the companies we lend to. It's our view that as a result of the size and scale of our business as it grows, and we have the capacity to lend in a size and scale commensurate with the way in which a bank can lend, then we bring our investors closer to the point of origination, and where the terms, conditions and the pricing are set and the fees are generated. So our view is, if you think about the market, you think about investors looking at, say, a retail bond, might buy a retail bond from a bank that's been arranged and structured. The investor will have no right to negotiate the terms or the conditions. They'll have no rights to set the pricing. They won't receive any funds. In fact, the banks will have received the origination fees and sold it to other investors for nothing. If the credit quality of that borrower or that issuer deteriorates, there's no professional management team to roll up their sleeves and support investors in terms of how to actually prepare or negotiate a recovery of the credit risk. So from our perspective, investing in a listed fund where you've got access to a team that are focused on origination, direct origination, where you charge the borrower an appropriate fee and that is income to our investors. And if credit quality deteriorates, you've got a team that are experienced in corporate restructuring, the ability to negotiate. And we're accessing private side information. So the ability to force a borrower to give access to information, P&L, balance sheets, cash flows on a monthly or quarterly basis, giving us insights in terms of the credit risk. This is really the market. This is what the Australian market is. It tends to be, you think the banks are AA rated, so from a AA rated position, they lend generally from A to BB. Heavily regulated, going below BB, it becomes punitive for a bank to hold those kinds of assets on their balance sheet. So that's the opportunity for us in MOT. MOT tends to be a BB to single B or lower credit risk with the ability to participate in upside gains. MXT provides investors with exposure from A to BB type credit risk. But you can see the market as a whole has experienced very low loss rates. And that's largely to do with the regulated nature of the market and the way in which we as lenders participate and lend money. But it's also a feature of Australian corporate insolvency law. Australia's corporate insolvency law is probably the most favourable, creditor-friendly piece of legislation in the world. If a borrower gets into default, our ability to wipe out layers of subordinated capital, be it equity, be it subordinated debt, where the risk should be worn. So if I'm investing in equity, I'm looking to generate growth in earnings, I'm looking to provide upside capital gains. For us, if equity is not appropriately wearing the share of risk, then it's not a debt transaction. It's an equity risk and it should be priced accordingly. So the benefit of Australian corporate insolvency law is a key protection for investors in terms of how they mitigate risk of loss. You can see in this chart, this is the point I made earlier, Australian corporate borrowers are heavily reliant on banks for funding. The market tends to be predominantly unrated credit. So most Australian companies do not have an S&P or a Fitch or a Moody's credit rating. So their ability to access offshore funding markets is quite restricted. So it's quite a beautiful market, really. You've got a heavily regulated bank group where they're finding it difficult to provide funding, and it's our view that they're not the natural holders of the loans. On the other hand, you've got borrowers that are captive to the banks looking for funding. And so the combination of that really creates a very stable, orderly market. And the demand for our services and the ability to negotiate and provide funding directly to corporates is a key means for companies to diversify their funding sources. So one of the reasons why we exist is companies are looking, how do I diversify away my funding sources away from the banks? We're a viable non-bank alternative funding source for them. This is the return profile of our various funds since inception. So the first fund we launched was the Diversified Australian Senior Loan Fund. You can see there MXT is the second fund rated here. The return target in that particular fund, as I said, is the RBA cash rate plus 3.25%. That fund has delivered that, and we're doing that in a low-cost way. The total cost an investor would incur being invested in MXT is around about 60 basis points. And when I compare that to unlisted bond funds or other unlisted funds, that's an extremely attractive fee structure for an investor to be exposed to, together with the combined benefits of having liquidity through an ASX exchange traded vehicle. And you can see the return profile of our other funds. So the credit trust there at the end is one of the vehicles that we've established really to provide investors with higher returning debt. But even in the case of higher returning or mezzanine debt, I would say that from a lender's perspective, it's still important that equity shares its risk. So when we might structure a mezzanine property transaction where the total loan to valuation ratio might be, senior debt might be capping out around about 50 or 55% LVR, the mezzanine might take the debt maybe to a total leverage of around 70%. So you've still got 30% of the capital structure at risk to equity. Sponsors are required to provide their own personal guarantees, and we might receive a return there anywhere between sort of 12 to 20%, depending on the risk profile. And so again, not as high risk as equity, still gets the benefit of the appropriate securities, but recognises the scarcity or the difficulty it is to access subordinated layers of capital in the Australian market. And you can see on the right-hand side, or the other side of the chart there, the low volatility that investors have been exposed to in MXT. It's a key feature of our market. Just to wrap up, I might just sort of say that in terms of, that's the historical performance of MXT and MOT. We've been successful on the market now, both with MXT to complete 3 separate capital raisings in 18 months. We've had very good, strong investor support, seeing that fund now go from establishment to around about 1.3 billion. In MOT, we deliberately capped the capital raising at 300 million. So our 2 funds offer investors a choice. A clear choice between a lower risk, more conservative funding option with income paid monthly, and investors that want an alternative to traditional fixed income, and alternatively with MOT, really a fund designed to provide investors with upside rights to participate in upside gains where investors are looking to generate equity-like returns.